Hey, if you're thinking about buying an indexed universal life policy or you just want to know how they work, you are in the right place. Today, I'm going to break down for you A to Z, every single piece and aspect of a universal life policy, an indexed universal life policy specifically. We're going to show you what the numbers look like, what I think's right, what I think's wrong, what I like, what I don't like, and how these things get used and promoted all the time. So, if you're ready for that, you're in the right place. Let's go over to a screen share. I'm going to break this down, and here we go. Hey there, I'm Derick Van Ness with Big Life Financial, and here we go, breaking down an indexed universal life policy for you, chapter and verse, so you know exactly what's going on. Okay, so you'll often hear these called IULs, right? That stands for Indexed Universal Life, and these are very popular in the marketplace right now. I want to break down how this works exactly for you. So, with any kind of permanent life insurance, as they refer to this, there are two components. The first one is what I would call the cost of insurance, right? This is your death benefit. And we all know about that, right? Like when you die, a life insurance policy pays out. So that's your death benefit. The second part of that is the growth piece. In this case, an index fund, right? And an index fund is tied to pieces of the stock market. We'll get into that in a minute here, right? And so what this really is you've taken a type of insurance and you've bundled it together with an investment. So this is kind of a buy term, invest the difference type of strategy. So let me show you what that means is the insurance in these kinds of things is, and this is super important, is what's called 1 year term insurance, right? So term insurance is insurance that's good for a term, like a presidential term, a period of time. In this case, this is a 1 year term policy that renews every single year. And then you have your index fund, which is your growth fund, which is tied to the different elements of the stock market. So as we break this down, I'm going to show a little chart here, right? When you are paying for, let's say you're paying, I'm going to use $1,000 a month. Okay. This obviously can be whatever. Your payment stays the same. You pay $1,000 a month into infinity, which is great. Feels very stable, right? That $1,000 is then broken into these two pieces, right? So in the beginning, let's say you're 35 right now. In the beginning, about this much of it, this small piece is going to be your cost of insurance, right? So let's say of that $1,000 a month, let's say $100 is going into cost of insurance, right? And then the other $900, this would be pretty aggressive, but you could maybe stretch one this far, but I'm just going to use this for example's sake, is going into the investment. Okay. So, you're going to invest that money. Now, this is great. Not a lot of cost of insurance, and you've got a lot of your money going up here in the investment piece, right? But then next year, when you're age 36, you're just a little bit older, so that cost of insurance is a little bit higher. So maybe $110 is going to insurance, right? And then $890 is going to the investment. And then the next year, you're a little bit older. And every year as this 1 year term gets a little bit more expensive because your chances of dying as you get older increase, right? And in the beginning, it's not very much. But as you get older, this increases at an increasing rate, right? This cost of insurance. And so what you can see is at some point right in here, and I find that this is usually in your late 60s or early 70s. And I'm going to show you an example of this. Somewhere in there, the entire $1,000 is now going toward cost of insurance. None of it is now going over here into the investment component to grow for you. Now, the theory of how these things are supposed to work is you build up a big enough pile of money over here along the way that as long as it continues to earn well, it will outpace the cost of insurance, right? Because what happens is once you get past this point, you now have a deficit, right? So let's say the cost of insurance here is $1,100 a month. Well, where's that extra $100 coming from? It's coming from the investment itself, and it needs to come over here to make up the difference. Now, if you're earning enough money over here because you've built up a bunch of cash, then that's no problem, right? And as long as the market continues to perform well, that could work. In fact, when you see the charts and they show you that you're going to get 7% forever on these things, or right now, I think it's legally they can only show like 6.5% on these. The number changes a little bit every year. But essentially, if they show that and you never had any volatility, it would work, right? When they show you what's going to happen with your money, they show it like this, right? That it goes into infinity, there's no blips. But we all know when you look at anything with the stock market, it kind of does this. Even if it's following that chart, you have your ups, which are awesome, and you have your downs, which aren't so great, right? But here and here are not the same thing as if you were just to get that same amount the whole way, right? And the difference between the average rate of return and the actual rate of return can be very misleading. And this is an important point. Let me show you this, and then we'll come back up to this chart. So when they show these charts with the smooth line, what they're showing you is the average rate of return, okay? Here's where that can be misleading. Let's say you put $100,000 into your investment account. And the first year, everything goes really well and it goes up 100%. And you're like, wow, this was awesome. I'm the best investor ever. I should do some more of this. The next year, everything that went right the first year goes wrong and you go down 50%. Okay. And you're frustrated by that. You call your advisor and they say, well, listen, you're up 100, you're down 50. That means over 2 years, you're 50% ahead. If we divide that by 2 years, that means you're 25% average rate of return, right? That's pretty good. Why, I would love 25% rate of return. But what actually happened is this, okay? The actual rate of return is you had $100,000. The first year it goes up 100. So now you go to 200,000. But then the next year it goes down 50. So it's cut in half. So that means you're back down to $100,000. Plus, there's always fees in these things, right? So you actually lost money, but the average would say you made 25% a year. That's not true. If you made 25% a year, you'd probably be somewhere in the $155,000, and all you actually have is 100, right? Well, actually a little less than 100. So when they show these averages and don't show you the ups and downs, which is what's happening here, then you're being misled. So if this thing was to get an average every single time it works because it can outrun it, the problem is this: as you get over here, this gets more and more expensive every single year, right? And as it gets more and more expensive, you need to earn more and more over here to keep up with those costs. And the second the market has a down year, doesn't have a great year, earns just a little bit, gets a zero. Because one of the nice things about these indexed funds is you'll never get a negative, right? You'll never go negative on your earnings. They also have a cap, right? So usually they'll have like a 0 or 1% minimum return, which is great. It means you're never going to lose money. They trade that off with a cap, usually like somewhere in the 12% range, 10 to 13%, just depending. There's a few things that change. So in the really good years, you only get 12%. On the really bad years, you don't lose money. Most people love this component, which is great. The problem is this: when you get 0, but you're having to pull from over here to fund the deficit over here, then you're going negative. And what you've done is you've reduced your ability to earn, because now there's less money over here, right? You're canceling some of that out to make those payments. At some point that turns, because this never stops getting more expensive. And the second that this can't perform and get you where you need to go, you end up in trouble. So let me show you what real numbers look like. I pulled up a real policy from a real human. I've redacted it here, but you can see here now, I know this is a lot. When you look at a universal life insurance policy, and this isn't just talking about a specific company, they're all structured this way. It's how universal life works. Those two components are the growth and the cost of insurance. But what you have in the account is you have the account value, and then you have a surrender value, which means really the money that you can get access to. You'll notice in a lot of these types of policies, in the beginning, there's a surrender fee, right? So what that means is if you needed to pull money out, usually in like they're all a little bit different. In year one, you can get 10% of the policy value. In year two, you can get 20%. In year three, you can get 30%. Um, and usually by year 10, you can get access to your whole amount of cash value, right? Um, in this case, this person is actually taking a loan, so the amount of cash that's available here is a little bit less. But what we really want to see with this is this. There's three groups here. There's this one, which is these three columns, and then there's a second one here, and then there's a third one here, right? Um, so these are all the same thing. These three columns, and these three columns go together. So this is showing if you got the guarantee, which is either 0 or 1%. This is if you got 4% every year, and this is if you got 5.9%, which is probably amount they can only legally illustrate or show with this policy. So I want to look at the guarantees. This is never going to happen. You're never going to get a 0 every single year. But what this does allow us to do as I scroll down here is it allows us to see what is that cost of insurance, right? What's happening with that and how does that change over time? Because it's pretty surprising. So this person is set up to pay. You can see their age over here, right? They're set up to pay to age 61. Yeah, age 61. And then, oh, actually to age 65 here. Okay. So you can see with this, they've been putting in 12,171 per year for 30 years, right? They've got $117,000 in here. So you know that in 30 years, they've put in a lot more than that, right? So this particular setup, if you just got the 0, is not super great. But what I want you to see is, even if you're not pulling any cash out over here, the cost of insurance starts eating away at your cash. It goes from here, you can see 129, even with them putting $12,000 a year in, this 129, the next year they put in 12,000, but it actually goes down. So the cost of insurance that year is more than $12,000. The following year they put in 12,000, it goes down by 3,000. This one, it only went down about 700, 3,000 here, another 3,000 here. Then it goes to 6,000 negative here, right? In their last year that they paid in. So the cost of insurance now is the 12,000 they put in plus $6,000 that they had to pull. If we go back over here, that they had to pull from over here to bring over here and make up the difference, right? So you can see how this works. And obviously very quickly here, you can see that this goes from 98 to 78 because now they're not putting any money in. 5531, $4,000. This policy would implode or expire at age 71 for this client. Now, obviously that's never going to happen, but I want you to see how that cost of insurance increases. Like you can see here we were going negative $3,000 plus the 12,000 here. So it was about $15,000 for cost of insurance. In this last year here, it went from 31 down to 4. So you can see that the cost of insurance there is $27,000 in that particular year. Now, if we look a little better scenario here, we look at the 4% scenario, like if you got 4% every single year, you can see that you end up with considerably more money here by age 65, 382,000 versus the 117, right? So that growth really mattered, really helped. But even in this scenario, you can see here there comes a point where the cost of insurance, so we can see we're still growing, but here starting at age 71, right? Which this is the midpoint, sort of the average between the high and the low. Even though, or you can see here that even with the growth of the policy, you've got $405,000 working for you earning at 4%, it still goes negative, right? It only goes negative $1,000 and it paid for the cost of insurance, which is great. But then you can see here it went down 2,000, 5,000, 7,000, 9,000. You can see that growing, and it gets really fast here, right? Here it's going down 18. Here it's going down 22, all the way down. And you can see in this last year here, now we're out to age 84, right? This went from 118 to 52. If I'm doing some quick math, I think that's $66,000 that the cost of insurance was by the time they're in this age to keep this death benefit in place, this $1.2 million death benefit. And you'll notice along the way, as the cash is getting sucked out, the death benefit's also getting lower. Now, if we go over to the last policy or the last version of this, the 5.9%. So if you got 5.9% every single year, then you can see here the policy is doing okay. It's growing, and right here at age 80, right? So even best case scenario that the law will allow them to show, this starts going negative, $2,000, $7,000, all the way down to, you can see in this final year here, now this person's 92, so they're old, but the cost of insurance is more than $119,000. You went from 249 down to 119. So what is that? $130,000 for cost of insurance for a $1.4 million death benefit. So the point here is this. If you're going to live very long, these type of policies don't work very well. Now, people might argue that, hey, we can get more than 5.9% on average, but there's a reason that they won't allow you to illustrate much more than that. And it's because the truth is, when you factor in the ups and the downs and the fees associated with the policy, that's the most they can legally do. Otherwise, we end up with a lot of lawsuits, and there are a lot of lawsuits on these. So let me tell you what I do like about these. They can grow your money, and especially when you're very young, that cost of insurance can be low, right? And then over time, it can grow. But as you get older, especially toward retirement age, which is really when you want these policies, you want the death benefit, and you're going to want this for income. What this doesn't show is this. This is this policy without the client taking out any money. See, cash from policy, zero. This is without them taking any income. This is all an entire loss. So you can see that this client's paid in for 30 years, $12,000 a year. That's 360 something thousand dollars, and they end up with zero. And I don't even want to go down the road that when these things implode, if you've earned a bunch of money in them, but then had to use it to pay for the insurance, you can actually end up with a huge tax bill as well. So you can pay a tax bill on something that you never even got to realize. They call it phantom income. So I do not love these types of policies for clients. Do I think a professional life insurance guy like myself, can I manage the risk? Do I understand how to do it? Yes. One of the things you can do along the way is you can lower the death benefit, and you can keep it as low as possible. And there's a balance you have to do based on how much cash you have in the policy. You can do that. You can mitigate the risk, but why would you take all that risk and have all those moving pieces and hope that it works out? Like, it's pretty scary. The downside is you lose everything and get a tax bill and you have no death benefit. The upside is maybe it goes pretty well. A lot of these, when they illustrate them out, they show that you're going to get millions and millions of dollars. I'm yet to see that happen. So I'm not a huge fan of these. I much prefer the stability of other types of life insurance or a more balanced portfolio for people. But the reality is this, these life insurance policies really set you up for danger once you get past this late 60s and early 70s. And at that point, it's too late. Other types of policies, you can turn them off. These you cannot. You can stop and surrender and just try and pull your money out, but then why were you using it in the first place? These are sold that when you get into retirement over here, you're going to get tax-free income, which is true. Life insurance, if you take loans, can provide tax-free income. I just don't think universal life is the right tool for it. And to put it into terms that maybe a lot of people can understand, when you go to buy a home, one of the things that a lot of people like about homes is once you have the payment, it stays the same, right? It's a fixed payment. Then there are people who go out and say, well, I want to take advantage of the ups and downs, and they get an ARM, right? Which is an adjustable rate mortgage. And we've all heard about these, right? Where when the interest rates are low, the mortgage is way lower. But since 2022, as interest rates went up, that mortgage adjusted. These universal life policies, instead of being like a 30-year fixed, which is more like a whole life insurance policy, these are more like an adjustable rate mortgage. Might be times when it looks really good, and there are other times where it's going to be a disaster. I think when you're making long-term plans, not having a variable earnings rate, not having a variable cost of insurance, and being able to know exactly what you're going to get, exactly how much it costs, and exactly where it's going to go is so much more beneficial. Life insurance, whole life insurance, the 30-year fixed version does have some ups and downs, but it always has a guarantee positive, and the cost of insurance never changes. Whereas in these, the cost of insurance can be lower early on in the policy, especially when you're down here. But long term, we know it's going to be much higher. And that's where you create the problem. A lot of people say, well, if I'm never going to lose money on it, I'm going to come out ahead. What everybody misses is this rising cost of insurance that eats these policies up. I've been on phone calls with people who've been paying in for 30 years and they have nothing. And I personally think these are some of the most dangerous policies, especially because most agents do not build them properly. People may say, oh, no, on our policy, we put in way more cash and we put in way less insurance, and there's a way to balance that. But the same thing is happening. It might just extend a little bit longer because this other policy I was showing you, like I said, this doesn't even show income coming out and this thing implodes. So it's not a great policy. There are better policies than this, but this is an easy one for you to see how they work. So that's my 2 cents on life insurance and universal life in particular. I believe that if you're looking at a universal life insurance policy, unless you have a very specific plan and you understand it to the nth degree, I would say that there are better options. I would continue to look. Everybody can make their own choices. You got to do what's best for you and your family. Talk to a professional, but I think it's really important that you understand this rising mortality cost and how big of a difference that makes. To me, that adds a ton of risk to this, and I don't think the upside is worth the trade-off on some other things where you can get a similar rate of return or better without all the risk. So that's it for universal life and everything you need to know. Now you know, how does this work short term? How does it work long term? How is it broken down? Where is your money going? And what I see as the biggest risks on this. I know a lot of people are not going to love this. They're probably going to put nasty things down in the comments. Give me your thoughts on what you think. Was this helpful or not? If you like what I have to say, there's a ton of other videos, so smash the like button, subscribe. We break down all kinds of things like this, everything from how to build your business to life insurance to different kinds of financial strategies, cash allocation, tons of things. We do not do investment advising on this channel, but we do have people on our team that know how to do that and would be happy to meet with you and talk about it. Anyway, thanks for taking the time. We'll see you on the next video. And that's it for today.